Is the stock market going to crash before the end of the year? That's the question we want to answer this weekend, as we can see that there is a lack of breadth and depth in the broader market. Looking here at the heat map, which shows the visual performance of the individual stocks that make up the S&P 500, it is pretty red. That's the first thing that I noticed going through this weekend's deep dive. The trillion-dollar companies are pulling ahead, and it seems like it is the trillion-dollar companies against the world. So that is not a very healthy sign for me. And this weekend, I just want to try to answer, what would a stock market crash look like, and how can we be prepared so that we're not looking back and like, oh, the stock market crashed. We want to know what the warning signs are when it's crashing. So I apologize ahead of time for the clickbaited title and thumbnail this week, but I got a gut feeling going into the end of the week. I just felt like things were not quite right. It's hard to put it into words what I felt like, but going through and doing my review this weekend, I can see that the underlying things that drive the market, meaning when we lift the, we're going to go buy a car, we want to know whether it's a lemon or a cherry. And what do? Well, we kick the tires, we lift the hood up, we walk around the car, we inspect it. And as I'm inspecting SPY in the broader market, I'm starting to see some pretty big warnings. So I would appreciate your support this weekend, because I think this video is going to be more important than ever as we go into the end of the month. What I would really appreciate would be a smashing of the thumbs up, and drop me a comment. What are your general warning signs that the stock market might be crashing? And again, I apologize if this weekend's a little bit more clickbaity. I'm going to go through exactly what would cause the stock market crash going into the end of the year. And we have to keep in mind that Goldman Sachs just raised their end of year target as well. So I want to start off by looking through this headline here to begin. This is from Bloomberg, and this is calling for bubble fears are rising as financial conditions flash boom time. So again, I am trying to dissect and understand what everyone is seeing and what is most important. And I also forgot there's a very important thing regarding the Fed this week that I went through and did some due diligence on. And I'll go through that right after we go through here. I'm trying to keep the video to 30 minutes, so I'm just going to try to focus on what is most important. I'm probably going to come back and read the rest of this article here, but just looking through to the very bottom, this is what kind of summarizes it to me. Bloomberg spoke to, let's just see who they spoke to. So they spoke with people including BlackRock, Rick Rider, right? Allianz's Mohamed El-Erian. They also spoke with, who else did they speak with here? Right, Rick Rider is a CIO. They also spoke with El-Erian. That guy's really well respected, especially after Bill Gross, right? The king of bonds is pretty much down and out of the market. I want to focus on this last thing here. They also spoke with the Invesco managing partner. And we can look here at, we are in a transition to a more normal economy. Invesco's chief global market strategist told Bloomberg Radio. That, to me, is the theme for 2022. And that suggests we're going to see growth moderate and defensive and large caps perform better. Isn't that exactly what we see on the heat map here? The trillion-dollar companies are the only thing which have a theme of going higher. Chips are strong. And it's actually only select tech that is strong, right? Apple, Tesla, Home Depot. Those look the strongest names, but there's a lack of breadth and depth across the board. So that's kind of the theme that I'm looking at into the end of the year and into 2022, at least for the first part. So if we break this trend, I would be thrilled. Why? I like making money going long. I think that we just got to be mindful of the downside here. Last thing I would note just before we move forward is going to be that we went from extreme greed back into greed here. So the market still wants to go higher, but when the rug gets pulled, we move down very fast. We could easily move back down into a neutral territory and then back down to fear, which is where I would get excited to buy stocks again. Why? We don't like buying when the market's greedy. We like buying when the market's fearful, and we have an unfair advantage. I'm going to try to tell the story really faster in the first 5 minutes. So the next thing I want to look at here is actually going to be a note that I've laid out here. So let's jump forwards and let's find this one that I pointed out here. So I'm going to jump forward to, if you guys wouldn't mind smashing the thumbs up, that'd be greatly appreciated this weekend too. So I actually want to jump down to the Fed first. It's between these two. And I have a note here. I'm going to go through and then I'll re-summarize. So let's go through here. Shakeup on the Federal Reserve. So this is the Board of Governors, which means people who are always going to be on the FOMC or Federal Open Market Committee, meaning voting members. and then they rotate the different seats for different years. So as of right now, Jerome Powell, unknown. There's a question mark. Richard Clarida, he's going to be gone in early 2022. Randy Quarles, he's stepping down before the end of the year. Lael Brainard, Michelle Bowman, and Chris Waller are the only ones which are guaranteed to be on the FOMC into next year. And then there's an open seat. So I want to jump down here to my note, and then we'll come back up and we'll try to explain everything. Sorry for not having this all 100% prepared. It's just a little bit unusual here. Where's my note? Here we go. This is the note right here. So I'm going to go back through and explain all this, and I'm not going to be looking at charts as much this week. I do have a very important part to look at the charts, but with earnings season done and the Fed right in focus right now, we have to focus on this. So all important data we need happens this week, meaning economically. Trump remade the Supreme Court, and Biden can remake the Fed. All the delays make sense if he is looking to actually shake the Fed up. If he was looking to renominate Powell, should have already happened. The market would have loved that. And I think that would have given him the potential to have the Fed separated from the politics. As of right now, the longer it takes for him to make his announcement, because they've delayed it a few times already, I think he's leaning on Brainard. And the reason why is because he can reset the expectations and also have a little bit more stimulus, which is what a president wants when they're going through a rough patch, and Joe Biden's definitely going through a rough patch. His poll numbers, meaning people who approve of his presidency, are at the low of him being president. Not a good look. We're 1 year out from midterms, and the prospects seem pretty bleak. All right, so I think Biden has the potential to remake the Fed, remembering that a term is for 4 years, and Jerome Powell steps down in February. So if we're going to get a shakeup at the Fed, I think that Joe Biden could potentially remake the entire Fed, kind of like how President Trump remade the Supreme Court. Why does this matter? The U.S. is the financial superpower of the world and the reserve currency. Also, if you turn the taps off, people don't like that. So how do you get reelected? By giving people money. So having someone who is going to be even more dovish, like Lael Brainard, would support him in the short term. What would it cause? It would cause long-term hangover. That's the problem. So short-term gains for long-term pain. That's probably the most important thing here. So I'll go through my story a little bit more in order now, but here's the takeaways. So right, Jerome Powell is steered us through the pandemic. Continuity for the markets, which means the person who laid out the framework and put the policies through the pandemic is going to be the person to actually see it through to completion. So what Powell's been telling us, this guy's been steady as a rock, right? Rock steady. So keeps the Fed insulated from politics as well. The reason why that matters is because if things go bad, again, tightening monetary policy, what Joe Biden can say is like, hey, this isn't my fault, right? I didn't hire this guy, Trump did. I like Powell. I think he's a very good centrist person for both parties to have a win. Lael Brainard, strong on regulation, opens one more seat. Why? Well, because if Jerome Powell's not the chair, he's likely going to step down and retire, which would mean that there's going to be one more seat to add to the Fed. And why does that matter? Because the people who are left over, he wants to make sure that it's going to be skewed in his favor, where they're going to print. Could expand policy mandate, which means they could actually have a different view on what is considered the mandate from the Fed. Right now we got a dual mandate, full employment, price stability. That could include, again, things like global warming, blah, 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 things like that. Or, having there be more between the minorities. And again, that's something we've been hearing a lot about, right? More disparity between minorities or the people who are the working class and don't participate when financial assets go up. Meaning if you don't own stocks, don't own property, when everything starts to get inflated, your wages are not boosting up fast enough to overset that. All right, so now let's step back for a moment and find out what the most important date for the week is. Why? It's really, 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 really important this week. There's some data coming out this week, and because earnings are pretty much done, This is what Mr. Market's likely going to be focusing on going into the rest of the week. There's a big fat star right here on Wednesday. And as I was going through, it was harder and harder and harder to ignore this. So what we can note here is that on Wednesday, we're going to be getting preliminary GDP numbers, we're going to be getting initial jobless claims, and then the FOMC meeting minutes. Joe Biden has also said that we should be hearing about the Federal Reserve Chairman nomination before Thanksgiving. When's Thanksgiving? The next day, on Thursday. So when should we be hearing about the Fed nomination? Before Wednesday, right? Oh God, this really matters. So the big concern right now is that we had last week we talked about 30-year high on inflation. It was huge, right? It was about 5%, 5-6%. So the reason why that matters is because if we're getting GDP growth at 2% and inflation at 5%, it doesn't take a math wizard to figure out that this doesn't really make sense, and this doesn't really seem transitory, at least for right now. Why? This is going to be a preliminary print. So the reason why the preliminary print matters is because it's the first time we see that number. After that, we're going to be hearing about the initial jobless claims, and with the Fed's dual mandate of full employment and price stability, meaning inflation, if jobs come in stronger than expected, that might actually skew the market to take that as a risk-off move to potentially sell off. Finally, the FOMC meeting minutes are going to be especially important because the people who remain on the Fed have been talking this week, right? Waller, Clarida, who's stepping down, has been talking. And what we want to know is how the market reacts to the data points and who is still on the Fed and who is going to be voting into next year, meaning what are they saying and how does the market take the news and then react to the news? That's what's important here. After that, we're going to be closed, right? We're closed on Thursday, so if there's a big negative reaction here or a big positive reaction, I think that going into Thursday with the market closed, the rest of the world is going to have to try to figure out what's going on. And then the ECB is also going to be very important. Speaking on Thursday, Christine Lagarde, what do? They're stimulating again. So the flip side here for the bulls is that as long as the pandemic continues to rage and continues to get worse in parts of the world, again, including Austria going back into lockdowns, Germany now with the worst numbers since the pandemic began. So as long as the virus is still dominating headlines, I feel like the central banks are going to be accommodative. They talk about it in here as well. So maybe a really good time for us to take a quick break and to go through here. I'm going to read this fast. I would encourage you to just click on the link in the description or pause the video if you want to read it. Bubble warnings are ringing louder after a week of dovish central banks bombshells fueled the easiest financial conditions in nearly 4 decades. 4 decades. BlackRock Inc. Rick Ryder and Allianz's Mohamed El-Erian are among those warning that systemic risks will only multiply unless monetary officials take more decisive measures to pair extraordinary pandemic stimulus. While policymakers are acutely aware of the dangers in the easy money era, their accommodative stances are encouraging ever-increasing flows to the riskiest markets. The crypto industry has hit over $3 trillion in value. The biggest junk bond exchange-traded fund is booming after getting the most cash since March. And major stock indexes are sitting at near record highs. No wonder a cross-asset gauge shows that easy U.S. investing climate is one for the history books. The risk binge is intensifying worries about market froth and lax central bank watchdogs. The world's biggest, the Federal Reserve, signaled last week a delay in interest rate increase until the labor market is in a better shape after it announced a widely expected reduction in asset purchases. The jobs number on Thursday is going to really matter if you read that statement again. The risk is you're creating overheating prices, Ryder, BlackRock CIO of Global Fixed Income, told Bloomberg TV on Friday. The risk to the system is you get too much liquidity in the system, creating excess. Here's a screenshot from the Bloomberg terminal. Easy going. U.S. financial conditions are near the loosest in 4 decades. What are they going to get? Even looser? Right? Man, that's bad. So again, when the virus gets worse, what happens? Well, central banks start to ease again, right? Basically printing. Last week, the Bank of England shocked markets with the decision not to raise rates. Meanwhile, European Central Bank President Christine Lagarde pushed back against wagers on a rate hike in 2022. They should be raising, but they are not. Why? Again, they can point to the virus and say things are still uncertain. We want to maintain our monetary policy, which got us here. And It's pretty unpopular to be saying that we're going to be pulling back in the reins and spending less. People love when they print. People love free money, don't you? Again, please smash a thumbs up and drop me a comment. Do you like free money? What do you think about this so far? All right, I'm feeling a little bit anxious so far. With supply side pressures threatening growth, central bankers risk either acting too fast and derailing recoveries or being too slow and letting inflation get out of control. Like we noted, those numbers are coming out on Wednesday. Officials are therefore taking a measured approach, despite some investors pressing for a more decisive end to pandemic stimulus. It's not clear to me why we need to continue to run monetary policy so hot, El Arian, a Bloomberg opinion columnist, said on Bloomberg TV on Friday. The economy is doing just fine, but the collateral damage it's creating, the unintended consequences that are resulting, are spreading. That is a Fed that's going to wait and I fear is going to fall behind, and we risk a pretty big policy mistake. Just thinking out loud here, I also remember that the Fed's balance sheet runoff usually happens into the end of the month. So if they are already starting to taper and they are not going to be there, and sorry, they normally already sell into the end of the month, that could be another leg of pressure which could drive us potentially lower. Again, what we're looking at here is that the stage is set. If we're going to get a move lower, all we need is the price action to confirm it. And there's only one ETF which is actually holding up, which is the $1 trillion company, $1 trillion COs. And I think that that's just because we're seeing a flight to safety. Whew. All right, moving forward. Catherine Mann, one of the Bank of England policymakers who voted to keep rates on hold, sounded a caution note in meeting minutes. Again, the same thing we're going to be hearing from the Fed on Wednesday. The ex-Citigroup Inc. economist was seen urging an early end to asset purchases. Again, basically meaning accelerating the taper. That's what they're talking about in the U.S., saying it was fueling an elevated level of risky asset prices. Look at this, right? Boom! Jeez. Junkiest junk bonds overtake returns across U.S. fixed income markets. What does that mean? Junk bonds are called junk because they're junk. They shouldn't be outperforming. Right, this is, again, it's getting frothier as we look further here. All right. Investors may be doubling down on risk, but at least they're building a protective cushion. So again, here's your bull side. According to the latest Bank of America Corp monthly fund manager survey, cash allocations rose to a net 27% overweight, the highest since July 2020, while institutional traders are hedging in the stock derivative markets. Again, we're going to look at that when we look at the options shortly at the end of the video. There are some clues as well. And with corporate earnings beating expectations, there are good reasons for credit and equity rallies in America and Europe. At the same time, while policymakers have been slow to turn off the liquidity hose, they're at least making a start, said Ryder. Could they do it a bit faster? Yeah, I think so, meaning accelerate the taper. But at least the door is open and we're moving in the right direction. Christina Hooper is among those downplaying a market rout scenario from any moderation in growth and tighter monetary policy, though she sees a cap in the rally for risky stocks like cyclicals and small caps, meaning the Russell. We are in a transition to a more normal economy. This is the most important thing, like we reviewed earlier. Invesco's chief global market strategist told Bloomberg Radio. That, to me, is the theme for 2022. And that suggests we're going to see growth moderate and defensive and large caps perform better. All right, lots of reading. Let's move forward. At about 18 minutes here, the video might end up being a little bit longer, but that's okay. This is a very important video, I think. Again, if you agree, please smash a thumbs up and just drop me a comment of any kind. I would really appreciate it. Last thing to look at here before we go back to the rest of the story is just looking at this calendar here. Again, this is shared from Walter Bloomberg on Twitter. Again, just note here, what's the day you notice on the calendar of key data and events? It's Wednesday. Wednesday's the day. There's tons and tons and tons of data. So by Wednesday close, we should have the Fed chair nomination, all this economic data shaken out, and the reaction from Mr. Market. All right. Whew. All right, moving forward. Wednesday pre-market and afternoon are critical for now, and we should interpret the data into the end of the year. Meaning, who is going to be on the Fed, and how does the market react to these data prints? If jobs are looking a lot better and GDP is slowing down, how do we react to that? Again, instead of trying to guess what the numbers are, let's look and see what the reaction is. The next day, the U.S. is closed for Thanksgiving. What does that mean? The rest of the world is going to have to also interpret the data after the U.S. after the U.S. does it, which means that feedback loop is going to start feeding. Lagarde comments on what is happening in the EU is likely a preview for what we can hear from the Fed. Again, if we have Brainard nominated, they're probably going to do what Lagarde did, right? Don't bet against the Fed. We're going to be more accommodative for longer. If Biden picks Brainard over Powell for Fed chief, expect an immediate market impact. What are they talking about here? Again, potentially a short-term bump from Brainard because Powell would be more of the same. And Brainard would be, whether or not she would actually be more dovish, she would be interpreted as being more dovish. What would that do? It would cause the potential for a rate hike to be lowered, and it would mean that we're likely going to print for longer. Again, that would be the interpretation from the market. Whether or not it would be accurate, we would likely see a short-term bump from Brainard being nominated, and with Powell, probably a whole lot of nothing. Again, that's what the expectation is or the base case. Looking through here, and again, the article's here on Slack. If you want to read it, it's in the SPX channel. Biden could appoint 3 other Federal Reserve Board members, and as many as 4 if Powell were not to be renominated and he chose to resign. If he's not the Fed chair, I have a feeling he's going to want to resign. He's from the private equity world. He's probably going to want to go back into the private equity domain. That's what I think. Also important to note that, Fed Vice Chairman for Supervision Randall Quarles recently resigned as well. What does this mean? Again, the whole Fed could be remade here. Looking through to who is going to be on the FOMC, or the Federal Open Market Committee, who actually votes next year. What's important here is that many of the names you're used to hearing are not going to be voting members next year, which means that their opinions are just that. They're opinions. It's like when we hear James Bullard talk, we're like, shut up, Bullard, you don't even vote. But next year he does. And this guy's been bearish, right? So we got Waller. So looking over here really fast, Jerome Powell, unknown. John Williams, he's going to probably be staying, right? New York vice chair. So we can note here that down here, these are the rotational people on the Fed. So in 2022, we're going to have New York, Cleveland, Boston, St. Louis, and Kansas, which means that we're going to be saying buy Mary Daly, buy to Evans, buy to Bostic, and buy to Barkin. What does that mean? We don't know, right? We don't know. The people who will be joining, Williams will be on the Federal Open Market Committee voting members, and then we're also going to have James Bullard, Esther George, and Loretta Mester. And then we don't know what is going to happen with the other 2 seats, right? With Kansas, and Kansas will be there, Esther George. St. Louis is going to be Bullard. Boston, Kenneth Montgomery, and for Cleveland, Cleveland would be Loretta Mester. So things are going to be shaking up, as we noted here. So permanent members are going to be getting shaken up, and then the rotation will fill up for the voting members. So again, this really matters. And what I'm not sure about is whether or not they're going to want to just nominate the Fed chair, or if they're going to want to announce who is going to make up the broader seats in the FOMC, and what the policy is going to be through 2022 and for the next 4 years for the next Fed chairman or Fed chairwoman, right? It's a 4-year mandate, right? That's a long time. If Joe Biden plans to be president or running again after the midterms into the next election cycle, he's going to want to have the person on his team at the top seat. Would he not? Yes. Fed minutes on Wednesday. We don't need to think too hard. The market will give us all the feedback we need. What's also important to note is that, let's go through here to the next picture. So we have the Fed chair nomination as the bull catalyst, or potentially a nothing burger with Powell, and then the Build Back Better is expected to get voted on and passed before Christmas. That's a long time away in this market. That's a month. Again, Build Back Better. So this is going to be, so we got the infrastructure stimulus. This is going to be the human stimulus, where we got social, climate, and tax, right? Yay, taxes. Something else to note here is just going to be, let's go through, not sure why it's not working when I click on the image. Anyways, bears step back. So S&P 500 index put call ratio declines. What does that mean? People don't want to bet against this market. If Lael Brainard is going to be nominated, we're definitely going to be moving higher, and that gives the bears a short rep to short into. We're already at the end of the year target, which means that I think the bears are kind of losing some of their steam. And when everyone is on the opposite side of the trade, that's usually when we can get an overreaction. What does that mean? If the bears have all been burned over and over and over, notably since September until now, maybe now is the time we can actually go down. Why? They're not betting against it. They've burnt their wads. Something else to look at here is just, again, wage pressures. So, right, look at this, 12, 15, 15, 15, 16, 17. That is inflationary, 100% that's inflationary. So, with wages going up and people not going into the labor market, that's a big problem. This is also very important here. Again, we looked at QQQ, but it's only the trillion-dollar company which are doing well. Again, those ultra mega cap technology companies. So we can look here and see that the Bloomberg new 52-week low Nasdaq Composite. We can see here that we got a huge spike into last year, and then we got a bump here into June, bump in September, and a bump now. By the way, those were the dips. June, September, those are the times that we dropped. All right, the underlying mechanics of the market are flashing a warning here. I.e., all important data we need happens this week economically. Trump remade the Supreme Court. Biden can remake the Fed. I have a feeling he's going to want to. This guy is not popular right now. What does that mean? He's got to do something. Print more money, right? Give people more money. They love that. They love it. They love it. They love it. We talked about the bubble fears. And on the other side here, what's important to note is that Goldman Sachs forecasts an S&P index climb to 5,100 by the end of 2022. They're also calling for the first rate liftoff in July of 2022. So again, we also saw a note. They were specifically calling for Amazon, Home Depot, and Coinbase to be leading the market higher, and they're not expecting a correction. However, a correction is 10%. A dip between 3 and 5% is not out of the question. That's kind of what I'm looking at for now, would be a dip. Potentially more, but as of right now, just really looking for a dip if we're going to crash, right? Sorry, if we're gonna move lower, probably just a dip. Also important to note here is that Fed Chair Janet Yellen is also saying that U.S. could hit the debt limit on December 15th now, giving Congress more time to strike a deal. And the reason for that is because of a letter sent to House Speaker Nancy Pelosi. Yellen explained that her revised estimate is in part the result of Joe Biden's enacted of the $1 trillion infrastructure plan earlier this week. What does that mean? More money means good for the government. Why would they not want to print more? What's really important here is that we have the debt ceiling hitting on potentially December 15th now. We have the December monthly OPEX on December 17th. And then also December 15th is going to be the FOMC meeting where we're going to be provided with a summary of economic projections. So I think I forgot to mention this, but again, also look here. There's an asterisk, which means that whoever is on the Fed in December is going to have to provide that summary of economic projections. So would it not make sense that we want to see who's going to be at the head of the Fed going into the summary of economic projections? Meaning, how do we interpret the data if we don't know who's going to be at the top seat as the chair? It's super important. We have to see that. And the longer it takes for Joe Biden to actually name his nomination, I think it's going to be Brainard. I think he's just trying to figure out how to announce it to have the best result for him personally. Whew. All right, going to take a quick break here, catch my breath, and go forward to the next part. Okay, so we went through the calendar of events, which is where we spent a lot of time, and hopefully you guys are getting value from this. Again, if you're enjoying the content, I would really appreciate a thumbs up and just drop me a comment. It helps our channel tremendously. I want this message to get out there, and I would appreciate your help this week. Let's go through some charts, and once we finish off the charts, we got a little bit more data, including options, and then SPY, and then we'll wrap up here. All right. So I'm going to do SPY last this week just because, again, we're going to look under the hood, we're going to kick the tires, we're going to walk around the car, and then we're going to look at the S&P more holistically at a high level with a bird's eye view. So looking here at QQQ, which is the only ETF which did well this week, we can see that it powered up. So it claimed a 261% Fibonacci extension, which is the dotted line, at roughly 403.5. 400 is going to be our uptrend into next week. That number is important as we look at the options chain for QQQ in the last segment of the show. XLF. So the theme as we go through to the next charts here is going to be that, again, we hit a target and then we backtest the previous tops. Hit the target, backtest the previous tops. One more time. Hit the target, backtest the previous tops. Last time. Hit the target, backtest the previous tops. Reject off 161. Backtest a previous all-time high. XLV. We already backtested the previous all-time high. So it faded, dropped down to the previous top, and then bounced off. As of right now, this has a cup and handle on the weekly with 131 as the apex into December 17th. Again, same day, mid-December. So already dipped, already going back up and starting to go sideways. Wouldn't that kind of mean like the S&P could like fade back down to X number and then rally back up and close exactly where it is right now? kind of like we land at the 470 end of your target. Oh, shit. Yeah. Fade it, rally back up, and then do nothing. Again, we're looking at scenarios here. XLE hit hard, especially on Friday. What is it? Why? I think it's because that travel is looking a lot less promising after the November 8th reopening. And look at travel stocks. They got absolutely crushed. So no travel, there's no need for extra energy. We're back inside the 53.5 to 56.5 pocket. Fears of the virus coming back is what I think the market is also starting to bake in here. Look at DIA. Again, here's the theme coming back. Stops going up, and it back tests the previous top. Interesting. Okay. So, XLF, check. XLV, check. DIA, check. What's IWM doing? Oh, it's back testing the previous top. Breakthrough to new all-time highs and back testing the previous top and actually a little bit lower. Also playing through to that theme that we saw in the other slide. I don't think I have it prepared here, but supply chain issues have been hitting all of the small cap companies. We're seeing transportation costs rise by more than 200% on a year-over-year basis. So we're back inside the channel here, 231 is going to be our uptrend for next week, and 233 apex into the following week, which means we have to basically just hold where we are. We don't want to go down. If we go flat, that's fine, but we can't really afford a dip. Back below 228, we're probably going to go for that 50 DMA. NYSE, or 2,000 stocks, the composite. What did it do? Broke the new all-time highs and then back test the previous all-time high. There's a clear theme emerging here, right? Yes, there is. All right, RSP, equal weight S&P, already making the move, right? Inside bar, higher high, and then we got a lower low in the same week, right? That's a nasty candle here, right? Oof, that's stinky. Ready for a previous all-time high backtest? It looks like it. XLU, winner from the infrastructure bill. Again, XLU is generally going to be risk off, which is risk aversion, and there's a head and shoulders versus a W forming. So I'm not sure which one's going to win. If the market's going to crash, I would expect to see XLU continue to grind up, invalidate this head and shoulders pattern, and push to new all-time highs. If it's going to fail, that should be good for tech, which means tech can rally up. So again, we have a W potentially forming here, right? W, but it looks more like a head and shoulders, but it is invalidating it. So again, a little bit confusing here, but it's showing us a risk aversion appetite. It's not just the US that's under trouble. Look at FXI here. Trash, right? Yuck. Clearly funneling lower, hit the downtrend, and rejected. Alibaba is really, really dragging right now. Emerging markets, hit the downtrend and reject. It's already below the 50. Might want to go back down to the 200. Why not? VIX. Closing over 20 is a bull break. Woof, right? When we're in the teens, the market is calm, cool, collected. Everything's silky smooth. No one's worried. Everyone's docile. And we're greedy. What does that mean? Everyone's getting complacent. This is a massive warning if it plays out. We're up 10% on the week here for VIX. That's a big move. So closing over 20 would be a reclaim of the gap. It would be a reclaim of the 50 MA. And it would also be a bull break. Watch out for that one. TNX. One of the only ETFs which closed red this week, and also telling us that this is probably why QQQ went higher, why we were lower by 3% on the week for TNX. Basically, all of that move happened into Friday. What did tech do on Friday? It ripped. All right. So this is a flight to safety. Why? People want bonds, right? They'd rather own US bonds than European ones right now. All right. Cup and handle, let's go back to here. TNX, cup and handle with or a W forming but not fully formed, right? So we got a cup and handle with the handle. All we got to do is bounce and reclaim it here, which would be bearish for tech stocks. Also have roughly an IHS here or a big W, right? Boop, 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 boop. I don't know. Looking bullish. BTC, also what? Backtesting the previous tops. Not quite the wick, but the real bodies, roughly at 57.5. That's where we're sitting right here as I record this video on Saturday morning. Finally, looking at ETH, exact same thing. Backtested the real bodies, not the all-time high, but the real bodies. That backtest last week of the all-time high was not enough. We went down for more, roughly to 4,000, same as BTC. And then gold, right? Gold actually did a lot better this week, which for me is also a clue. Right, we rejected off the downtrend here, but we're right at about 1850, key area. As we look at the weekly chart, we can also note that the IHS is holding, We're testing here at 1873 one more time, which would mean if we close above 1875, the weekly and monthly would both break bullish. What are the takeaways here? They're pretty obvious. I'm going to tell you what I see. Am I the all-seeing eye of Sauron, where I know exactly where the market's going to go? Of course I don't. But I also know that my gut has helped me more than it has hurt me. And since last week, I've been waiting for the crash, right? I'm calling it a crash just because that's what everyone else calls it. I'm looking for a dip. So if the dip's going to turn into more, we'll form a weekly lower high and a lower low. As of right now, we don't. All the ETFs are showing weakness, meaning that they've back-tested the previous all-time high. For us to go into correction territory, they have to lose those previous all-time highs. As of right now, it's just a test, right? That's all it is. It's a test. We can dead cat bounce off the all-time highs into the first half of the week, and if the reversal's real, I would expect that by the close on Wednesday, after the economic data comes out and the Fed minutes are out, and we got that Fed chair nomination, that should be it. We should be resuming back up higher. If we don't, that's the warning sign for me. I already have everything else that's already brewing here. QQQ is the sole bull ETF. TNX helped it dramatically. It looks like a flight to safety in lockdown fears. As we noted during this article here at the very bottom, we are in a transition to a more normal economy. That's the transitory story that we should be focusing on, transitioning to a normal economy. That to me is the theme for 2022. And that suggests we're going to see growth moderate and defensive and large caps perform better. Fear and greed also showing us that same morning here. All right, I'm at about 36 minutes. I'm going to go to S&P, and then we'll look at the options last year. I'm going to go through a little bit faster now, but it's really important we get the bird's eye view here. So again, look at S&P. It is at the high of the month. It is ultra bullish. We're approaching the end of the month. Holding 465 or the 423% extension is bullish. The uptrend for next month is roughly where we are right now, 465. So again, by looking just at the S&P or top down, you would have no idea there is weakness here. It's not evident. Looking on the weekly chart, we got a higher high, we got a higher low, it's flagging out. Looks like a bull flag. If this is the only thing we were looking at, we would say, that looks like it wants more. That's what I would say. All right, looking at the daily chart, getting to some shorter time frames now. Riding the uptrend on an IHS, also bullish, right? V bounce off the IHS right here with an inverted hammer right on support. That should be a buy. Into monthly OPEX, they closed at basically 469. The 460 straddle got minted. From last week, we talked about how there was $9 in premium. So what do? They got their money back. Incredible. Looking at the hourly chart, this is now a revised one where we can see that the upper trend line has been very good for where we actually top out and go for those short-term dips. So if we were to power up to 475, it's probably going to be a sell. That would be the Brainard top, in my opinion, before we get a tick back down. Over 475, and it's a bull break. So that's what's really important too. If Brainard can get us over 475 and we hold that through to Friday, after Thanksgiving holiday on Thursday, that's really important. Early clues here on Monday at 4 p.m. for the 470 apex, which means if we go green into Monday and close over 470, maybe we're going to get that bump into the first half of the week. Whew, right? Hopefully you guys are hearing the story that I'm telling. I really hope so. All right, now we're going to look at the final cherry on top. Now we know the meat and potatoes. Now we're going to look at the sundae and know whether or not the cherry on top gives us any confirmation, meaning the options. So Monday we got at the money. Who cares, right? At the money. Wednesday, at the money. With a small straddle at 470 being built. This is what it looks like. Why? There's open interest and there's volume. Okay, cool. So at the money, implying a big move on Wednesday. Again, why? Well, we got about, again, I'm going to call it $2 in premium here. We got about $3 here. That's about $5. What does that mean? We have to either push up to 475 or push down to 465. And with all that economic data coming out on Wednesday, and it being the day just before Brainard, I think that's why we're seeing this. Everyone's like just waiting, right? We're waiting for the other shoe to drop. That's what we're waiting for. And a straddle implies just a big move. It doesn't know which way it's going to go. It just implies a big move. 5 points. We want to go to 475? There's your evidence. We're going to start crashing? There's your evidence. We'll know by the end of Wednesday. The options confirm it. Looking out to Friday, it's quite muted. Naked 475 call, and it's muted otherwise. Again, that's the Brainard move, in my opinion. Otherwise, it's very muted here. Everyone's kind of sitting on their hands and waiting for the other shoe to drop. I'm not going to sit. Why? When these guys start to sell, we take the elevator down. I don't want to be caught in the elevator down. I'm hopping off. All right, anyways, moving forward to December. This is where it also gets interesting. And again, if you wouldn't mind smashing the thumbs up and dropping a comment, I would greatly, greatly appreciate it. I took a lot more time to prepare the narrative for this weekend, so make sure to support me. I would really appreciate it and continue to deliver videos just like this one. All right, 470 straddle. So again, it's small. And the reason why this is really notable to me is because we've been seeing 100,000 plus open interest on both sides for the straddles. What does this mean? I'll go through my notes here. So a 470 straddle, which is small, about 20,000 in volume. It's notable to me. The call and puts are roughly the same. Again, we closed at 469, so about $1, $2 more in premium for 470 puts. $50 in premium implies 455. Hold on. Let's take a break here. What's 455? Hold on. Wait. Hold on. So every other chart, excluding S&P, is basically either back tested its all-time high or fallen lower. What's that level? 45405. Oh, geez. Do you understand? I hope you do. All right, moving forward. If you don't, I'm telling you, the evidence is here that if we're going to go for a back test of the all-time high, they're already positioned. They're positioned right now. I'm not betting heavy on it, but they're ready. And the flip side here would be that we would go up to 485. If so, 470 plus 15 would be 485. The difference here is that there are no meaningful bets, bull bets, over 480, right? We got some naked open interest here. This looks like a call spread though, right? 472 to 482 call spread. Let me actually just do this here so you can actually see it. 472, 482. So there's no other, that's it. That's a call spread. I think this is just hedging. If whether or not this actually goes bullish, they don't want to pay it out. So there is significant put interest all the way down to 400 though. What does that mean? In my opinion, the 470 end of year target is hit, and no one is putting on fresh bets right now up into December. What does that mean? The gamma squeeze is waning. So the market's been, if the market's been going higher because out of the money call buying is forcing the market makers to buy the underlying stock to cover the exposure, that gamma squeeze is not here like we've been seeing in every previous monthly review. All right, QQQ. So QQQ is the number one ETF in focus right now. There is no meaningful volume next week. There is some. I don't want to show it because I don't want to get focused on small moves. I'm looking at the big picture here. The big picture is that next week we also have another big, for next month, December 17th. Again, mid-December. Looks like it's really important here. Really, really important. We have a 400 straddle. What does this have? $17 in premium, which implies 383 or 413. 383 is also the previous all-time high on QQQ. Do you get it? Do you get it? The only ones which have not joined the party for that previous all-time high backtest are literally QQQ and SPY. Where's this QQQ? Oh goodness, oh goodness, oh goodness. It's 382.8, I believe. 381.8 is the real body. 383 is basically the previous all-time high. Do you see it? Do you see it right there? That red line. Yeah, right there. Those previous tops. So the bears are positioned for a previous all-time high backtest on SPY, seeing that exact same thing happening on QQQ. Okay, so let's wrap up here and just finish off the story. So for QQQ, again, 383 is the previous all-time high. I'm watching that close. 25K in volume at 387 and 385 put. Again, that just is that's a put spread. It's roughly the same notes as S&P. There is no fresh bull bets into December, and there is more puts, but it is not overwhelming. What does that basically mean? The narrative from here is playing out. That to me is the theme for 2022, and that suggests we're going to see growth moderate and defensive and large caps perform better. What does that mean? If the market goes down, these will go down less. So would it make sense to bet against the $1 trillion club? No. But betting against the market, yeah. Being properly hedged, yeah. So the reports for this week, not showing them only because the story here is very obvious and we don't have to show you more evidence to make sure you hear it. There's a 4-to-1 roughly bear to bull flow on the ETFs, on bonds, and also on emerging markets. Everything is pointing to down. I would love to be wrong, but for me, again, by looking at the car, meaning just literally looking at the S&P notes. Let's go back to here actually. So finish off with this. The market is still greedy. And we are only seeing select names do well. How do I know? My portfolio got pretty hit this week. I own some trillion-dollar companies, but clearly not enough this week. So, chips lead tech, tech lead SPY. The question for me this week is going to be whether or not the trillion-dollar company can power up and just drag the S&P higher with the rest of the entire market getting soft. I don't think so. It's not just the US that has an issue right now either. With fears of another lockdown roiling the rest of the market and everything saying it is time to take the foot off the pedal, at least until Wednesday, Thursday. Why? If we're going to get that Santa Claus rally straight up into December, I think that we can just wait until Wednesday and Friday, because Thursday's closed, to get that confirmation. So, if not, we wait for the previous all-time high at 454, SPY, and 383 QQQ, and watch for the reaction. It's that simple. Don't have to overthink it. That's my video for this weekend. I would really appreciate a thumbs up. And finally, if you're watching all the way till the end here and you want to know more about what we do, we are going to be having a Black Friday sale starting on Monday, and we have a lot of evidence and more supporting evidence you can use to be better prepared for the potential for a dip here. What am I basically telling you? Make a dip buy plan. Whether you're in our group, whether you're just watching on YouTube, preparing a dip buy plan into the end of the year is very important. It's also important because the theme for 2022 is starting to emerge. Is it fully emerged? Is it already confirmed? No. We only know that by looking in hindsight. Hindsight is always 2020, but bubble fears are rising as financial conditions flash boom times. Thank you for watching. Again, finally, would appreciate that thumbs up and drop a comment, and I look forward to seeing you next weekend. Thank you, thank you, thank you.